Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending April 4th, 2025. And this week I am titling the video Disastrous Trump Tariffs Put Us on the Brink of a Recession. But can markets bounce first? I know it's a long title, but it was a long week. And I'm host of InvestTalk, Justin Klein. And if you checked out my episode on Thursday, you'll know kind of how I feel about these Trump tariffs. And this is, there's no easy way to put this. This is a disastrous policy that, unless it is reversed in a dramatic way in a very short period of time, will spin us into a recession. There is no ifs, ands, or buts about it. It will 100% be a recession. We're already having borderline negative growth this quarter, but it's going to get a lot worse with this policy in place. And this was the market for today, for the week, and you can see there's really no place to hide here. Everything's deep red, and a lot of things are down, double digits. Look at the banks. Major banks are down dramatically. Even the ones that were bastions of strength in the insurance space, those are still down, 6% or so on the week. And even on the consumer staple side, Philip Morris is a name we've owned for a while, and that was down 5% on Friday. Ended up being down about 3% on the week. But what that showed you was this was forced selling. There was a lot of hedge fund liquidations and margin calls over the past couple of days, and they're just selling kind of everything. So usually when you get that type of event, you get some type of a bounce once the dust settles a little bit, and I do expect that. But the damage, most of the damage has been done. Now, once again, as it keeps on at these levels of tariffs, which are drastically multiples higher than what the reciprocal tariffs that everyone is expecting would be. Okay, these are ill-conceived, ill-advised, and just absolutely dramatic increases in tariffs, and it will cause mass layoffs and freezing of the financial system. There will be no lending. It would be an '08 type of crisis. Now, I do think that there will be those within Congress that will push back. This will threaten everybody. Even if you're a Trump loyalist, it will come for you because it will be wide ranging, just as '08 was wide ranging. Now, am I putting the odds of it staying these levels at better than 50%? No, I'm putting that at relatively low because like I said, Congress can step in, take the power of tariff away, and there's already riots in the streets. There are already protests around the country, and there are people on the right that are already turning. You can see that here. Ben Shapiro, President's vision of international trade, I'm sorry, is mistaken. He's a star. He's one of the loudest voices on the right, and I think this is going to intensify rather quickly. And getting economic data. This is what the non-farm payrolls were for March. But we're in a different world now. This is blown up global supply chains, the global economy, in short order, and we're on the brink of something very disastrous. And the question is, will those within the circle, within Congress, will they step up, and will they prevent these from truly being implemented? They need to be rolled back, not just in a handful of countries or in a minor way. I'm talking about dramatic way. If you want to roll back to actual reciprocal tariffs, that would be one help, right? Japan's tariff on us, for example, is 1.9%, and our tariff on them is, I believe, in the 20s. Okay, and none of this, absolutely none of this, is close to reciprocal tariffs. So, we'll see how this goes. Usually, once again, you get a bounce when you get this type of forced selling, but if these stay in place, you will get a bounce that will be and probably should be sold. you're starting to get the odds of a Fed rate cut in May to creep up here from 18% 1 week ago now to 33. I expect this to be 100, over 80% by the end of the coming week. So we'll watch for that, and that will weaken the dollar. And then this is bank credit. We talk about this all the time. And if I zoom out, what you can see here is this is the growth of bank credit. And great banks are the ones that create money in the system more than the Fed, more than any other entity. It's banks, and whether they are lending or not. And you can see in '08, this went deeply negative for an extended period of time here. Really, look at this 2010, 11. This went negative in mid 2009, and it was basically negative through 2011. And that's when you can see 2012 and beyond. That's when the market kind of spun, or the economy spun out of its malaise, when you had good credit growth. And then you got kind of too much credit growth here post COVID, and had a correction and a slight dip negative that kind of corrected that inflationary impulse. But it soon bounced back, and we're in the 3% range, which is not great but not terrible. And it was trending higher if you go to a 1-year chart here. But as of late, really since the election, it's been trending lower, and that's a worry. And in this type of environment, this will break lower because you can't lend in this situation. Not only that, there's no credit demand. Who's going to want to spend? What companies are going to want to spend? There will be layoffs, and this will be a recession. There's really no arguing whether there will be a recession at this point. It's just a matter of how bad it will be, and how bad it will be dependent on who will step up and prevent this level of let's call it economic terrorism is really what this is. And we'll see if those in power, that have some power left in government, can pull us back from once again the worst economic policy in 100 years, so pretty much. So that's where we're at. I don't want to sugarcoat it to you. That's just what it is. Now, we are at some support here around the 100-day moving average, sorry, 100-week moving average, the 382 retrace from the 2022 lows. And would it shock me to get a bounce? It would not, but we did close below it, which tells me eventually we get down to 4,800. Do we get there next week on another puke lower early in the week before that bounce? I think that's certainly possible. Or we get that bounce here quickly and we bounce up back into the 53, 5400 on the S&P, and then eventually a rollover later in the spring and into the summer. I think those are kind of the two scenarios at this point. And I can zoom over to some of the other indices. We can look at the NYSE. I was like, that one's a little bit better just because it's a broader index. And this one's at the 382 retrace and the 100-week moving average as well, and a bit better support. We're certainly oversold, and this is due for a bounce. And like I said, when you get forced selling, they kind of sell everything, and then once that's kind of abated, then you can kind of get those sellers out of the way, and dip buyers will come in. And I think that's what you see here. Now, we came into this year thinking we were going to get a choppy environment for most of the year. We expected the real volatility to happen in the back half of the year, but obviously, when the president says reciprocal tariffs, he doesn't mean reciprocal tariffs, because that's not what he put in. So you can't really anymore believe what is proposed. It's clearly going to be more extreme than anyone has expected, and you have to start adjusting accordingly, and that's what obviously we will be doing. You can zoom. Let's go to the Nasdaq. The Nasdaq has definitely still been the weakest, and you can see here same thing. Now well below this 382 retrace, heading to the 15,000 mark on the Nasdaq, and once again that could be after a bounce and then a retest, later in the spring or early summer, or you get that in short order. We'll see. But clearly, this is a market that has deteriorated very quickly. The VIX is at levels where you do typically see a bounce in markets, right? You see this surge higher, but this is one day, right? Look at COVID. This is 1 week. Look at COVID. You had about 4 weeks before this kind of settled out and the market reversed. that may not, you may have another, couple more weeks of this volatility. That's where you get down to the 4,800 on the S&P, et cetera. So, once again, unless somebody in government comes in and tries to float some reversal, I do think you get another move higher, and you get that 4,800 in the S&P rather quickly. And maybe that's what it's going to take. We shall see here. The dollar, that's what's interesting here, is the dollar had a bit of a strength, but it was still down on the week. Look at that. Look at the red on the week, right? So you had some strength on Thursday. But really what this is showing, sorry, some strength on Friday, which is really showing you on the move on Thursday is that, we had a very risk-off event, but the dollar was weak. This was telling you that money is flowing out of the United States. The vision of the world that America was a safe haven. It was a place where you can trust your capital, that you will get rule of law, that you will get reasonable policies, etc., and that we're, their allies. That is gone, and therefore money will continue to flow out of the United States and into those foreign markets. And I think that's a trend. For years we had money, just constantly flowing into the U.S. But what you can see here is the EFA to the S&P, and what you can see here is, look at this trend here. This is just consolidation. It moved higher. That means the foreign markets were outperforming the S&P. And after all this carnage, what did it do on the week? Foreign stocks outperformed U.S. stocks on the week. So to say that this policy is good for America, it's certainly not good for the American markets, good for American companies, etc. It is, simply put, a disastrous policy. Bar none, hands down, simple as that. Gold, let's take a look at gold. Gold did pull back on over the past couple of days, but I think this is more of a, once again, sell anything you can. And gold did pull back here. Now, could it pull back even more? Sure, it's definitely overbought, but this still remains a good place to be overall compared to equities. Let's take a look at bonds. You said the 10-year Treasury rally. What you can see here, look at this. This is all about getting rates lower. Well, rates were lower and bonds were higher early on Friday, and it closed near the lows of the day, just like the whole market did. So this is not, whatever this plan is, it's not working. It will not work. It's not going to work. It is absolutely suicide for the United States economy, and frankly, the global economy. And you have to treat it as such. Okay. Let's see what else. What else do I want to get to? Let's go to credit spreads. Let me pull up this. Oh, here's the growth to value trade. This is always interesting. So this still headed lower, even though oil, had a very bad day. Oil stocks, which typically in the value side of the market, this is energy. This is obviously very oversold, but it's still value still outperforms growth on the week. So it just shows you that you're getting that rotation in companies that have better balance sheets, good earnings, etc. And so I think that will continue. So here's the credit spreads. This widened out and obviously hit a new low. This is another sign that a bounce is something you want to sell. Now, once again, the bounces can be strong. In bear markets, bounces are very, very strong, and you get 5, 8, 10% rallies very, very easily. So once again, could you get a bounce up here into the 54, 5,500 level? I think that's certainly possible. So we'll see what we get next week. Another interesting thing, let's go to the Mexico ETF. So Mexico did sell off here, but it actually rallied on Thursday. So Mexico does look to be a relative winner. So I did want to highlight that because it's important to pay attention to what areas of the market are outperforming. Utilities did have a rough week, but once again, this is kind of selling everything, even though these are bond proxies, and utilities are likely to be a place to hide at some point. But same with consumer staples, that sold off, but ultimately it will likely bounce back. There's going to be a shift. Like I said, there already is on the right. They're going to realize that this is disastrous and is going to change the way people feel about the president and his policies. And the sooner that those on the right and in government start to come to that realization, the faster this market will recover. And I think we get there at some point over the next week. It's just a matter of will it be in the next couple of days or next week or two. So we shall see. The move index, here's another indicator, right? That this is just a disastrous policy. This is the VIX, basically the volatility index of treasuries. So the idea that this is going to allow the treasury to refinance the debt at lower rates is just completely false. And what this is creating is a system where there's going to be a negative feedback loop on the broader economy, and you're going to have tax receipts crumble, et cetera. This is the antithesis of what is reasonable policy. Okay, so that's kind of where we're at. We'll see if we get any leadership out of government that prevents this from being implemented. If we get any inkling of that, any rumors of that, the market will fly. I will say that. So that's really the only saving grace here, to be honest with you. Industrials, if you think this is going to be good for U.S. industrials, U.S. manufacturing, well, the industrial sector ETF is telling you very, very different. So that's where we're at. I don't want to tell you, I don't want to be the bearer of bad news, but this is the reality of the situation. I will not sugarcoat it for my listeners, for my clients. We will be making adjustments to portfolios on that bounce and shifting money out of really anything that's that could be in the crosshairs of just bad policy coming out of the White House. So that's where we're at. I appreciate you all tuning in and liking and subscribing to this channel. And reminder, the contents of this video are for educational purposes only and should not be considered as recommendation to sell or buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.